Bank health is an indicator that shows a bank's ability to manage its financial and operational functions effectively, maintain stability, and protect the interests of customers and other stakeholders. In practice, bank health is crucial because a healthy bank contributes to the overall stability of the financial system. Therefore, bank health assessments are an important tool used by financial regulators, such as the Financial Services Authority, OJK, in Indonesia, to ensure that banks operate in accordance with standards that minimize risks to finances and customers. Bank Health Assessment Method. CAMELS. In Indonesia, bank health assessments commonly use the CAMELS method, which is an approach that evaluates banks based on 6 main indicators. 1. Capital. Capital is a crucial measure to assess a bank's ability to absorb losses and face risks. OJK assesses whether a bank has sufficient capital to cover various risks that may arise in its operations. The main capital ratio is the Capital Adequacy Ratio, CAR, which measures how much capital the bank has relative to its risk-weighted assets. The higher the CAR, the stronger the bank's position to withstand financial shocks. 2. Asset quality. Asset quality assesses the health of assets owned by the bank, especially loans granted to customers. The higher the asset quality, the lower the likelihood of non-performing loans, NPLs. This assessment is important because loan defaults have the potential to cause losses and weaken the bank's financial condition. Banks with low NPLs indicate that they have effective credit risk management. 3. Management. Effective and high-quality management is essential for a bank's overall health. The management factor includes evaluation of the organizational structure, leadership, strategic planning, risk management, and internal controls. Banks with good management are more effective in conducting operations and managing risks that arise from their business activities. 4. Earnings. Earnings are an indicator of bank profitability, showing whether a bank can generate consistent profits. This assessment uses ratios such as return on assets, ROA, and return on equity, ROE, which measure the bank's profit in relation to its total assets and equity. Strong profitability levels indicate that the bank can survive in the market and build additional capital needed for expansion or improved service quality. 5. Liquidity. Liquidity indicates the bank's ability to meet its short-term obligations without having to sell assets at a disadvantageous price. A liquid bank has sufficient reserves to meet customer withdrawals or new loan requests without facing default risk. The main liquidity indicator includes the loan-to-deposit ratio, LDR, which measures. 6. Sensitivity to market risk. Sensitivity to market risk assesses the extent of the bank's exposure to changes in market conditions, such as fluctuations in interest rates and currency exchange rates. A bank that is sensitive to market changes has a higher risk if shocks occur, such as a sudden increase in interest rates. Therefore, market risk management is necessary to maintain the bank's financial stability against external influences. Bank health levels based on CAMELS assessment. Based on the CAMELS assessment, banks receive a score that reflects their health status. Typically, this score is categorized as follows. 1. Healthy. A bank with a healthy rating has good scores in all CAMELS indicators. This means the bank has sufficient capital, high-quality assets, good management, strong liquidity, and is not overly vulnerable to market changes. A healthy bank is more resilient to economic challenges and has a low risk of failure. 2. Fairly healthy. Banks in this category still have good performance, but some aspects need improvement. For example, the bank may have minor issues with liquidity or a slightly higher NPL rate. Overall, however, the bank is still able to manage risks and remain stable. 3. Less healthy. Banks in this category begin to show issues in several CAMELS indicators. They may have low capital, high NPLs, or ineffective risk management. Banks that are less healthy need attention from regulators for improvement to avoid potentially larger problems. 4. Unhealthy. Banks in this condition have low scores in most or all CAMELS indicators, indicating that they are in a critical state, have very high risks, and are vulnerable to failure. If not addressed immediately, an unhealthy bank risks going bankrupt, which can have adverse effects on customers and the financial system. The importance of bank health for the financial system. A healthy bank plays an important role in the economy because it can channel credit to productive sectors, supporting economic growth. On the other hand, an unhealthy bank can increase systemic risk, where financial problems in one bank can spread to other banks and disrupt financial stability. Therefore, regular bank health assessments and monitoring are essential to ensure the safety of public funds, maintain public confidence, and ensure overall economic stability. In certain situations, regulators can take action against banks considered unhealthy, such as providing liquidity assistance, requiring restructuring, or, in extreme cases, closing the bank. These measures are taken to protect the interests of customers and maintain the stability of the financial system.